This chart compares historical secondary equity offerings. Way over here on the right, towering above the rest, is the $80 billion capital raise Alphabet announced on June 1, 2026. It is the largest secondary offering in corporate history. Buried inside that massive total is a highly specific anchor, a $10 billion private placement from Berkshire Hathaway. Take a look at this data visualization comparing two massive numbers. The green block represents the $174 billion in operating cash flow Alphabet generated internally over the last 12 months. The blue block represents the $80 billion they are now asking for in external equity. When a company is generating that much cash organically, asking shareholders to take the hit of stock dilution is highly unusual. The partnership looks even stranger from the buyer's perspective. For decades, Warren Buffett built his conglomerate strictly avoiding capital-intensive technology companies, favoring businesses with predictable economics and simple cash flows. To understand why these two giants suddenly need each other, you have to look at what's being built. High-margin software is taking a back seat. Generative AI requires physical, massive, and incredibly expensive hardware. Right now, enterprise demand for AI services is vastly outstripping the actual physical hardware available to run them. Google Cloud is sitting on a contractual backlog of $460 billion, simply waiting for the compute capacity to catch up. This line graph maps Alphabet's capital expenditures. In 2025, they spent $91.4 billion. For 2026, management expects to spend up to $190 billion, effectively doubling their output to buy chips, land, and energy. You might wonder why they don't just borrow the money. As we add this new layer to the chart, you can see Alphabet's total debt balance has already crossed the $100 billion threshold. If they tried to pile another $80 billion in loans on top of that, it would risk immediate credit downgrades and significantly drive up their interest expenses. That leaves the equity markets. By issuing new stock, Alphabet secures permanent capital that doesn't require monthly interest payments, keeping their balance sheet intact even during a macroeconomic downturn. Here is how that $80 billion is structurally divided. This block chart splits the package into three tranches: a $30 billion public stock offering, a $40 billion at-the-market program, and the $10 billion private placement. Looking closely at this $40 billion at-the-market section, this is a strategic accounting maneuver. Alphabet is using a sell-to-cover model. As employees' stock units vest, Alphabet slowly sells shares into the market to pay the associated tax bills. This allows the company to hang on to its corporate cash reserves instead of draining them to pay the government. Then there is the $10 billion private placement block. Berkshire Hathaway agreed to buy directly from Alphabet at a locked-in price of roughly $348 to $351 per share. That gave Berkshire about a 6.5% discount compared to where the stock closed that day in the public market. Flooding the market with $80 billion in stock all at once would crash the price. By slicing the raise into distinct phases and locking in a massive anchor buyer up front, Alphabet guaranteed their funding while cushioning the blow to their current valuation. That anchor commitment came directly from Greg Abel. As he steps in to take over the CEO role, Abel is tasked with deploying Berkshire's nearly $400 billion mountain of cash. He is moving fast. Within a single 48-hour window, Abel committed $16.8 billion in capital, splitting it between the Alphabet tech deal and an all-cash acquisition of homebuilder Taylor Morrison. Even with a massive $10 billion check, Alphabet's overall size means Berkshire owns less than 1% of the company's total equity. They have no board seats, no voting control, and no operational oversight. But that passive stance is exactly the point. Berkshire built its empire owning foundational infrastructure, like energy grids and freight railroads. Abel is simply applying that same logic to the digital economy. The data center is the new rail line. Abel is securing a discounted long-term stake in the physical utility grid that will power the global enterprise economy for decades. The public markets were far less enthusiastic. As shown on this stock ticker chart tracing the days following the announcement, Alphabet shares dropped nearly 4%, while Berkshire remained completely stable. The sell-off reflects a sobering realization. The physical servers, cooling systems, and massive energy requirements of AI come with soaring depreciation and brutal operating costs that will heavily weigh on profit margins. Spending $190 billion a year on hardware is easy. Converting that spend into actual, sustainable revenue takes time. The return on this invested capital is going to take years to fully materialize. The ultimate winners in AI will be the organizations capable of funding massive quantities of concrete and steel without breaching their own balance sheets. This video is for informational and educational purposes only and does not constitute financial or investment advice. To track current market temperature and historic valuations yourself, download the Buffett Indicator iOS app today. And if you want to understand the numbers driving the market, join our community at deepvalues.ai and subscribe to the Deep Values channel.